Hello, everybody, and welcome to another episode of the Cross Country Super Podcast. And as usual, I'm joined by Jemma Sanderson over in the lovely Western Australia and specifically Perth. How are you, Jemma?
I'm good, thanks, Darin. I'm good. It's lovely sunny day here, and it's starting to really warm up. So that'll be interesting. An earlier start to summer, but that's all good.
Well, I wish I could say the same about Sydney, but we keep going through these fluctuating cycles of we get a warm day and then it's cold again, and then it builds up and it gets a little bit warmer and then it gets cold again. So I personally would like that cycle to stop, but you know, there
But
are many
then it'll
things
be
I
too
can.
hot, and we'll be
No,
complaining
no, no.
about that too.
I'll never complain that it's too hot. And there are many things within my control, but unfortunately, the weather is not one of them. But
Too
today
true.
we are actually going to talk about something that comes up quite a lot in strategy discussions and certainly the makeup of self-managed super funds, and that's the different components that come together when we're talking about whole of fund review and action, and that is the difference between the taxable component of your superannuation savings and the tax-free component of your superannuation savings. So maybe we can start, Gemma, by talking about how the two components come to exist
Yep.
and yeah, where we
But
go.
the background to it. So I'm going to show my age here. Back in the day, pre 2007, when we had the simpler super regime come into play, there was, I think, about 6 to 8 different components, and one of them was pre 1983. So pre 1 July 1983, if you had service. An eligible service date prior to then, you had that component. Then you had a post 30 June 1983 component. You had an undeducted contribution component and various other bits and pieces coming through. And it determined then, and still determines now, what is taxable when you pull money out, depending on how your age flows through. So back in the day, if you took out an amount from your July component, only 5% of that was taxable at your marginal tax rate, whereas the post-July component was taxable at the 15% sort of tax rate plus Medicare levy. So they were taxed quite differently. And then you had your undeducted contributions, which were always tax-free. And there were some strategies you could put in place if you had a good pre-component because of the way the formulas worked. If you made a big undeducted contribution, you would increase your pre-component and reduce your post. Just because of the way the formula worked. Anyway, so that was history. And then when the simpler super rules came in, what happened was those components got consolidated into what's now the tax-free and taxable component. And at 30 June 2007, there was a requirement for all super funds to undertake those calculations and keep them on record. So when the 2006-2007 accounts were done, that was really where that calculation occurred. And what was included, so your undeducted contributions and your pre-component, as well as a 1994 invalidity component and a couple of other ones combined, and that was crystallized to be your tax-free component, and then really the balance was your taxable component. And back then, in light of what those components were, and this is where you could cherry pick the components too, because you could say pre and post into this account and then undeducted contributions into this account. So pre 30 June 2007, you could move the chess pieces around and engineer it so that you had one pension that was all tax-free and another pension that might be partially tax-free, partially taxable, depending on how that if you had pre components in there. So you used to be able to cherry pick. So in the lead up to 30 June 2007, we had separate pensions being put in place to cherry pick and set up and sort of quarantine those components. And then from 1 July 2007, we had those taxable and tax-free components in place. And so now what determines how those components work is whether you've got a pension or not. And I'll get to that in a sec. And then any contributions that go into the fund, the type of contribution that it is. So if it's a non-concessional contribution or a CGT contribution or a downsizer, that counts towards the non-concessional amount. And then the taxable, the concessional contributions generally form part of the taxable component. But the way that it works in accumulation is that your tax-free component is based on that non-concessional, those contributions made, and historically if you had that amount sitting in there, and then the balance becomes taxable. So if if it's fixed, say at $1 million, because back in 2007 you could throw $1 million as an undeducted contribution in. If the growth an amount goes up in value, then your $1 million is there, and that increase it becomes a taxable component. Likewise, if it goes down though, you'll end up with that being 100% tax-free component then, because that's how that gets captured. And you may end up with like a negative taxable anyway. That sort of works itself out. So, but there is a different position with the accumulation and pension, because we've now transplanted from the way that that used to work into now what people call the proportioning rule.
So would I be right to say that as a rule of thumb, just to cut through, and we always say this, non-simpler super, because it's just not simple. But as a rule of thumb, if it's a non-concessional contribution, which means you don't claim a tax deduction for it, that goes into the tax-free component. And if it's concessional, obviously by name, you get concessional tax treatment for it, then it goes into the taxable component of
Yep.
member's benefits, basically.
Yep. Rule of thumb. Yep. Absolutely. Yep. And now, so then we've transplanted now, we've got this proportioning rule. So I mentioned before that you could cherry pick. Now you can't. So if you want to take, if you've got, I don't know, $1 million sitting in your super and it's 50% tax-free component and 50% taxable component, and you're in accumulation, if you are eligible to, of course, if you want to pull out $100,000, you can't take it all out of the taxable component or all out of the tax-free component. It has to come out proportionately. And so it's the 97 Act section 307125 goes through how that proportioning rule works. And so it's different for accumulation and pension. So if you've got an accumulation account, it's the dollar value of that taxable and tax-free component just before you take the money out. That proportion applies to the lump sum. Where it's a pension, it's the proportion. So every pension payment you take out, it's going to have the proportioning rule effectively applied to it. However, the proportions that the pension was at commencement that applies for the life of that pension. So the example I gave earlier of having like a 100% tax-free pension pre 30 June 2007, and that can still be engineered these days, is if you take out money from that, that will be 100% tax-free component, but that is of benefit when that person dies, because it was 100% tax-free at the start and it's 100% tax-free at the end. So when that pension gets paid out, if that can be specifically directed to non-death benefits dependents, then it's going to be tax-free, as opposed to one that might have separate components in it. And so, of course, that taxable component will flow out to non-dependents and be subject to tax. So you can, this is like, it often, with this sort of planning, what we're looking at is saving tax for the kiddos, and I mean the adult kids, rather than it impacting the individual themselves, because these days preservation age is 60. And so you can't, and once you're 60, where you're eligible to take money out of super, it's all tax-free in your own name. So it's really undertaking any planning to save tax at the back end on your death.
So just with a pension, if they do take a lump sum out, that will have both components in it. Is that right?
So it depends again on the commencement of the pension. So if I had $1 million and it was 50-50 and I started a pension at that time, then it would be 50-50 for the life of that pension. If I took a lump sum or a commutation out of that, that would be 50-50 at that point in time.
Okay, that's very interesting. Now, obviously, you mentioned that for estate planning and I suppose generational wealth transfer, if you're talking about that, these components are very important if you do want to minimize tax for the recipient. How
Mhm.
does that all work? And what difference does it make if a death benefit recipient gets either a tax-free or a non or taxable component?
Yeah, so this is probably one of the bigger issues that I know I'm having discussions with clients about is that's their concern is the tax on the back end effectively. So where you're a non-death benefits dependent, so that's a tax provision. So you've got in super, there's the cis dependent, so that determines who can receive a benefit directly from super. So that's a spouse, a child of any age, an interdependent, a dependent, and then the estate. So from a super perspective, that determines who can receive a benefit directly from the fund. But then you need to look at the tax side of things, which tells us the tax position of those benefits for that ultimate recipient. So with the tax dependent, that is a spouse, a child under 18, or a child under 25 who's still supported by their parent or at university, a financial dependent. So you could be a 45-year-old child and still being financially supported by your parent. And so you would fall under that realm, but that whole financial dependency consider, that's a whole nother like hour-long podcast. So if you're a financial dependent, those tax components or tax dependent rather, those tax components are almost irrelevant because you that if it's taxable, you still get that treated as being tax-free when the money comes out of super as a lump sum, as opposed to a non-tax dependent or a non-death benefits dependent. So we're talking independent adult kids here. So that where that flows out either directly to them or to them via the estate, then the taxable component of what they receive is taxed at 15%. And if they receive it directly from the fund, there's an extra 2% Medicare levy that applies to that. So you can see where having separate pensions and trying to keep components separate can be of benefit because let's say I've got my $1 million sitting there, and to start with, when I started my pension, it was 80% taxable, 20% tax free. And I had my pension there and I started that. And at the back end, all my benefits are going to a non dependent. So it'll be 80% taxable at 15% if it goes to the estate, with Medicare levy on top if it goes directly to the kids, and 20% will be tax free. Now, if I happen to put in place a withdrawal and recontribution strategy where I take an amount out of my $1 million pension, say it's the 360,000, I'm eligible to put the money back in. So I take out 360 from that pension. It's a commutation, gets reported for transfer balance cap purposes, da 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 da. Then so I've taken that out of my pension. So that's then contribution into my accumulation. So I've then got a pension that's separate to my new accumulation, and it'll go into the accumulation as non-concessional, which means it's the tax-free component. And then I can start a new pension with that 360. That will then be 100% tax-free component. So I'm going to have $640,000 that's 80% taxable, 20% tax-free, and $360,000 that's 100% tax-free. And then over time, if I'm just taking out the minimum payments from those accounts, then the difference is pretty negligible. But if I decide to take out more than my minimum, you would take the minimum out of the tax-free 100% tax-free pension to try and maximize that, and you'd take any extra bits from the sort of taxable pension so that reduces over time. So then overall the taxable component is going down, so that then when the money goes to the estate or to the beneficiaries who are non-death benefits dependents, you've got a tax saving there. Yes, that is simple. Clear as mud, right? Clear as mud.
So basically, if you are, I mean, as you mentioned a little bit earlier, you can't, the rules don't allow you to really cherry pick anymore, but it does allow you some room to move
Hmm.
with strategy to try and minimize your tax position. But I suppose the clear message would be that if you're doing anything, I don't know, in terms of a commutation or anything like that, you must always try and preserve your tax-free component.
Yeah.
Do
Yeah.
do whatever adjustments that you need to make through your taxable component in some way potentially to reduce your ultimate taxable component.
That's right. But also the other consideration with this is that, by and large, it's not benefiting mum and dad now. It's really them doing some ultimate, estate and tax planning in the future. So the other consideration with all of this is, okay, well, if we move $360,000 from, in the situation I just said, so that moves 80% of 360, and I'm going to get my calculator out because it is, what it is. So that's going to save $40,000 in tax by undertaking that pull 360 out, whiz it back in, start a new pension. So that, that's better than a stab in the eye with a blunt stick. And so no doubt clients are like, oh, that sounds great. Then you come to the practical side of implementing this. So you can't just do a journal entry of, oh yeah, take it out, put it back in. You've got to practically move money out of the fund. So from, Homer's account out to Homer personally, and then from Homer back into the fund. Then if you are commuting from a pension, you've got T-bar. You've got to figure out, how all that sort of flows through. Then you've got a new pension being commenced. So that's more T-bar. Then you've got the assets themselves. So if you've got $360,000 sitting there in cash in the fund, easy. That comes out, goes back in. But a lot of people, if they're reasonably fully invested, they might not have that level of cash there. So how might they do it? They could have 100 grand in cash. Well, you can still do that, but you might be going 100 out, back in, then 100 out and back in. And then how many times? It's 100 out, back in, then 60 out, back in. That's 4 transactions, 4 commutations, 4 contributions. And then once it's all lumped in there, you might start your new pension. So the practical side of it, and then obviously that all comes with advice costs and other transaction and implementation costs. You could do the lump sum out as off-market transfers, but again, that's the cost involved in that. I'll call it the faffing around factor. So sometimes people are like, nah, too hard, too bad, too sad, I can't be bothered. And particularly, so I'm talking here, we're in a pension. So when we're in our pension, we know those tax components because we started the pension some time ago. If we had a lump sum, when we take that lump amount out of that lump, so if we're in accumulation rather, if we take out a lump sum to sort of engineer this, so if we can do 360, that comes out, we'll need to then know on the date that comes out what the value of the account is to determine the tax components on that date, to then determine what those components are that have come out. And then if we're doing that 100,000 each time that I mentioned, that is even more faffing around, because the way that the benefit and how we can sort of quarantine or segregate these pension accounts is because a pension account is considered a separate superannuation interest. So with my accumulation of $1 million, that was 80% taxable, 20% tax-free, that's a separate interest. If I pull money down from that and put money into accumulation, then that pension will always be a separate super interest. But the accumulation is, all accumulation accounts within a self-managed super fund are considered one account for superannuation interest or proportioning rule purposes. So you can't, again, that cherry pickness, the only way you can really then separate out accumulation is by starting a pension. So I'm not doing this very good justice. So let's say I wasn't in pension, I had $1 million sitting there in accumulation. I pulled out 360 and then I whizzed that back in. So what that will do is I started at $200,000 of tax-free component. When I take out my 360, that will be 20% of that 360 coming out is going to be tax-free component as well. So that's 72,000. So my tax-free component started at 200, has reduced down by $72,000. Got that right? Yep. And then, but I'm then adding back 360. So 200. So now my tax-free component in the account is 488. No, that's not right. This is why we have these fun times, don't we? So 72,000, 488. 488,000 will be my new tax-free component of my $1 million, because my accumulation account has sort of money's come out of it but gone back into it, and then it all gets aggregated in there. Now, if I pulled that 360 out of my accumulation and then started a new pension with what was left over, then that separates out that interest. And then when I throw my 360 back into the fund, that then becomes that accumulation account is then separate to my pension account. So you've also got to be careful with about how all of that timing works too, because you want to keep them separate as much as possible.
Yep. Well, obviously complicated as
Mm,
always. And I know that we always sort of digress into other areas. But again, it sounds pretty simple in theory.
in
But
theory.
there are a lot of things that you still got to take into consideration if you are to undergo withdrawal and recontribution strategy. And that is one thing obviously to keep in mind is the contribution thresholds
Mm,
and
yep.
what you can and can't do. It's all very well to say that, oh, that sounds fantastic, Gemma. I'd love to increase my tax-free component in my superannuation fund. How do we go about it? I've withdrawn this amount. Oh, but hang on.
Can't get it back in.
Yeah.
And that's exactly right. So it's become, the consideration there is, well, you don't want to pull money out of super if you can't get it back in. So, but it's a good way to equalize sometimes. So you put, invariably, Homer pulls it out of his account, and maybe he's got $2 million in super as his total super balance at the previous 30 June. So he can't contribute it back in, but Marge might be able to. So, that can help from the equalization perspective. So with all of those considerations, the first thing is, if I'm going to pull it, well, can I pull it out? So you've got to have met a condition of release from that perspective. Then if I do pull it out, can I put it back in? Because you obviously don't want to do that. And is it 360 or is it 240 or is it 120? What does that look like? Am I going to achieve the outcome that I want? If I do pull it out, am I eligible to start a pension to then be able to, plonk it back in and have it be able to be sort of quarantined from that perspective. Now, with the increase in the non-concessional cap, without having to meet a work test and the bring forward up to age 75, that's sort of opened the not the floodgates, but it's enabled more people to put in place these sorts of strategies. But you do have to be careful with how they're implemented. The other thing that we do see is those clients that want to implement a strategy, but they're, say, last 30 June, they had more than 1.9. So they were over. But as they plot up to the next 30 June, they're like, right, I still want to implement this strategy. I'm eligible for a 3-year if my total super balance is low enough at 30 June. And so what they might do is withdraw the money in June. It sits there in their personal bank account or their personal name. So at 30 June, their total super balance has dropped. They fall under the threshold, and then in July they make the contribution and go on from there. So you can see that, one of my favourite terms is it's got a high faffing around factor, and there is a high faffing around factor here. But if you can save your kids 40 grand in tax with a few transactions, then people are pretty happy with that being the outcome. So it's just a matter of, again, having those conversations with clients about how it works. And it does become a bit more faffing around where you've got T-bar commutations and things like that. But again, if it's a little bit of paperwork and obviously a cost that's involved in the transactions, but then it's saving the kids right now, if someone was to die, 40 odd thousand, and that's just going to increase in value as hopefully the assets do, then again, people are pretty comfortable with that being the outcome.
Yeah, and no doubt, well, obviously, I think to not directly quote from Kerry Packer, but he basically said, which Australian wouldn't like to pay less tax, because who wouldn't? But I think this will become even probably more important, and a discussion for another day is where the bill for the Division 296 tax is at the moment. But if that does actually get passed into law, obviously we are going to see a lot more consideration, if not execution, of these rebalancing strategies, as you say, and that could actually end up being a double benefit, couldn't it?
Mm.
For the
Yep.
person who makes the non-concessional contribution back into the fund, because all of a sudden they've changed their mix of taxable and tax-free component as well, which is, it's not obviously the reason why they're doing it, but it can be an added benefit from actually doing it.
Yeah, and I think that's the other thing, that like with the transfer balance cap being introduced, as well as the this division 296 tax, I think there is going to be a higher emphasis on trying to rebalance. So invariably, the one member of a couple often has a lot more in super than the other, and before 2017 it just didn't matter. But now, of course, it does. And so, if that rebalancing can occur, and because you can make those contributions up to 75, I think we're going to start seeing more of that happening. Also, people will probably be a bit more conscious of that, where they, once they hit that 60 mark and they've met the full condition of release, they might be more conscious of, okay, I do need to equalise my spouse a bit, because we're 60 now, but if we're going to be in super for 20, 30 years, then we want to make sure that we're mitigating this div 296 tax using two transfer balance caps. So those, like, equalising helps there as well, obviously subject to the non-concessional contribution provisions, and then that added benefit to the kiddos down the track if that can mix up those taxation components.
Yeah, no, fair enough. And Jemma, you're at the coalface, obviously. I'm not. When people actually commence their pensions, do they take, this mix into consideration? I mean, ideally, in a perfect world, we'd all love to start a pension with totally tax-free money,
Yep.
but obviously that's not a realistic possibility. But do people actually go into commence pensions with this in mind and being conscious of what implications this sort of component or component tree uh, will have, or the effect it will have on their situation?
Yeah, definitely, and particularly if they're hitting retirement and they're about to start pensions, that's a prime time for them to put in place a withdrawal and recontribution, take the money out, then start a pension. So that obviously then sort of quarantines those components there, a fresh contribution into their accumulation, and then that can be considered separate. Now, that's only going to work for people where they're under their transfer balance cap and can put in the fresh contribution, because if you say had $4 million in super and you started a pension, like, and you took out the money, well, you can only start a pension up to your transfer balance cap. So again, it's very difficult. It's more difficult to engineer it to keep 100% pension. Again, the faffing around is a bit higher, and you might end up you trigger an excess transfer balance that you'd then have to resolve. Does it achieve the considerations? And so, because what you're trying to avoid, if you can, only if you can, is taking money out and then recontributing it back into the same pot. So you're not getting that benefit of having separate, like a 100% tax-free account as much as possible, or pretty high. But
Yeah.
I mean, it's any amount that you can whiz around and increase your tax-free component is still of benefit, obviously. But you've just got to consider all these other things in there, like the contribution caps, transfer balance cap, total super balances, and the ability to make those contributions back in. But most people, and again, back to the practical implementation of it, where they've got the ability to pull out the money easily. So cash is king in these scenarios. That's an easy, straightforward process to go through. Then most people certainly do look to put that in place.
Yeah, and one of the questions that often gets raised, certainly gets raised in front of, well, by trustee audiences that I host sometimes, but also among advisors as well, is it's often asked, how many pensions can you have?
Mm.
Obviously, it's unlimited, but then the next question will often be, well, why would I want more than one? Like what
Yes.
purpose does it serve to have more than one? Surely one can just suit my needs and whatever. But what we're talking about, the componentry of superannuation, that's kind of the justification of, well, this is why
Yeah.
potentially you want more than one pension.
Yeah, and we do get asked that often in that estate planning context. So the estate planning lawyers are talking about, okay, well, I'm doing, looking at the holistic estate planning for the individual. We're doing their wills. Why has Gemma got four pensions? So, okay, well, they've got different components. But then that also gives rise to the situation where, so you can't cherry pick components, but you can cherry pick accounts. So if you've got four pensions and they've all got different tax components in them, from an estate planning perspective, you could say, right, well, the one that's got the high taxable component, let's direct that to the financial dependent. If it's got a high tax-free component, let's direct that to the adult kiddies. So that, you've got then a bit more flexibility there from an overall tax planning perspective. But it's definitely a question that we get asked a lot.
Yeah, I mean it's not really surprising because I think there's also that misconception of I can only have one pension.
Mm.
That's obviously definitely not the case, is it?
Yep, that's right. And we also have to be careful when we are commuting pensions and so a lot of pensions are set up to be reversionary. I personally don't like reversionary pensions as a general rule, but if a pension is already reversionary, changing it to be non-reversionary, and it can be a challenge if someone's over their transfer balance cap, so they've got accumulation. If you were to stop that pension, so the gold standard of making a reversionary pension non-reversionary or vice versa is you cease it and then you start a new one. So if you've got a 100% tax-free pension that's reversionary and you don't want it to be reversionary, then you cease it and it then goes into accumulation, but it then will be aggregated with all those components. So then your new pension won't be 100% tax-free. It'll then be dependent on the mix at that particular time. So that's again the care that might need to be taken when you're starting pensions. And I think we've mentioned it before. Reversionary or not is not a checkbox thing. It's really important that people are aware of the implications of that. I don't like them because of the transfer balance cap administration faffing around factor side. And now with the Division 296 provisions, if it's reversionary, it's likely to result in some extra Division 296 tax being paid for those people who are over the threshold. So a couple of reasons there for it not to be reversionary when you can achieve the outcome without having to have a reversionary pension. But I would not be looking at stopping them without like a lot of consideration. So the tax components is one element of that. The other element is Commonwealth Seniors Healthcare Card. So a lot of
Yeah,
people had,
we know
you
that
know all
old
about that.
man.
A lot of people had their pensions in place well before, I think it was the 31st of December 2015. And on 1 July 2016, the income test for the healthcare card changed. So if you had your healthcare card by the 31st, so you had to have been in receipt of the healthcare card, then your pensions from super, the income wasn't assessed towards the annual income test. But from that date, it is assessed in a particular way. I can't remember. I think it's deeming or anyway, whatever it is. So if you change a pension that was pre 31 December 2015 by stopping it and recommencing it, then it's going to fall under the new rules. And if that ends up with someone being ineligible for the Commonwealth Seniors Healthcare Card, then, good luck to you. We'll be
Yeah,
blacklisted
no,
for life.
no.
So yeah.
That's a really good point. And I know that this topic comes up a lot, and I know that we always talk about always consider the social security implications of it because I don't, and again, I'm obviously not a practitioner, but story upon story I hear is that if you touch a person's Commonwealth or ability to have the Commonwealth Seniors Health Card, it will not go down well.
That
And
will not
it
go
can
down well at
even
all.
be that, well, a particular strategy might be beneficial, but if you touch that, no, there's no
You're
future.
out.
There's no future in.
You voted off the island, or
Yeah, yeah. The tribe has
um,
spoken.
the tribe has spoken 100%. And the other thing, because the benefit of those cards can be astronomical to a lot of people from that health perspective. So, I get it. I completely get it. So it's again having those conversations and being aware. The other thing to touch on with the tax components is, and don't shoot the messenger here. So the components, you've got tax-free component, which is, the naming of them is actually quite helpful. So you've got tax-free, easy, taxable, but within the taxable component, you can have taxed taxable and untaxed taxable. So the taxed taxable is what most people will have. So you're in a self-managed fund, you're in a public offer fund, your super contributions have gone in, your concessional contributions I'm referring to there, or your non-concessional, but they've grown in value. So over time, you've paid 15% tax, or tax has been paid on earnings and concessional contributions. So on basically the taxable income of that account. So that will always be taxed taxable because it's been taxed along the way. In some accounts, there will be this untaxed taxable component. Now, that tends to occur in constitutionally protected funds where money goes in, the sort of employer contributions go in, but they're not taxed along the way. And the earnings aren't taxed along the way. So in WA, we've got the Government Employees Super Board, or GESB, or GESB, and GESB has got a couple of these sort of legacy accounts. So one's called West State, the other one's called Gold State. I very rarely see Gold State anymore because was a defined benefit account. But with West State, they still knock around. They stopped any new accounts being set up from 2007 with those changing rules, but you still do see some untaxed taxable components. So what you need to be careful of there is when you hit 60, if you've got tax-free and taxed taxable, whatever you draw out, you're not paying tax on. But if you've got untaxed taxable in there, then that is still taxed when it, say, moves from that accumulation account into drawdown, so into pension, or it moves out of that GESB environment, or whatever the constitutionally protected fund environment is. That untaxed tax will be hit with a 15% tax rate when it gets moved into that non-constitutionally protected fund environment. The other thing to be aware of there is that untaxed taxable component is there's a calculation that applies when insurance proceeds are received. Also, when a member dies and a lump sum gets paid out to non-death benefits dependents. So that is a function of whether the age of the person at the time and their eligible service date. So what will happen is, and then that untaxed taxable gets whacked with, you would have heard a lot, in some of the articles and things, watch out, danger, 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 watch out for this 32% tax rate on death benefits. And that applies to an untaxed taxable component. But a lot of the time, that is not enormous because of the way it's based on an eligible service for the individual who's died and their number of days to age 65. So where they die quite young, so say in their early 50s, and their beneficiary is a non-death benefits dependent, so you're talking generally a child over 25, then you're going to have there might be a bit of tax to pay there. So just to, again, watch out from that perspective.
Well, that's absolutely classic. And I suppose if there is one thing consistent is that even the simplest concept can be made complicated by
Oh,
the
yeah.
superannuation laws, because you started by saying tax-free, taxable, well done, easy
Was well
concept.
done.
But
Easy
but
concept.
then we move into untaxed, taxable, and that creates a whole other myriad of things that we have to consider. But why would we expect anything different? We are
Yeah.
talking about superannuation law here, and we all know that it is fairly complicated.
Complex. Yep, that's right.
But
The other thing and this, you're going to love this too, Darin. So I mentioned earlier the ability to sort of cherry pick accounts for estate planning purposes. So this is more an awareness. You can do that, But some people might say, because if you have, and I mentioned earlier that all accumulation accounts in a self-managed fund are aggregated for superannuation interest purposes. So for that proportioning rule. Now, the tax office's view on a non-reversionary pension is that when a member dies, that pension ceases and becomes an accumulation account. So if Homer's got 4 different accounts, all with different tax components, and none of them are reversionary, then all of them cease and they all become basically a single accumulation account. Now, no one ever accounts for things like that in that way. They will always keep them separate accounts, and the law allows that to happen for component from a component perspective. So technically, as soon as Homer dies, all of those non-reversionary pensions, those 4 non-reversionary pensions, all become a single accumulation account, but those tax components are not aggregated at that point in time, because we see
Okay.
that a little bit as well.
Well, that's a little bit helpful, I suppose, at
Yeah,
least
win.
that
It's a
you
win.
do actually get to compartmentalize
Mm,
those elements, because otherwise, what a dog's breakfast it would be if you weren't allowed to do that.
100%.
And kind of counterproductive too, because in the whole time of having those 4 pensions, you would have been quite fastidious in the reason why they
Mm.
existed, and for that purpose, if the pension recipient dies, and then to just have it just wash back into a big pool, it wouldn't really make very much sense, would it?
Well, you then just wouldn't even do the strategies. And then that would be a potential reason to have reversionary pensions, provided the ultimate beneficiary is who you wanted to get the money, because then they don't cease, but it works out well. So, in addition to the components not being aggregated when it's non-reversionary, you also get the benefit of the pension exemption until those pensions are otherwise dealt with, which is also a benefit. And that was one of the biggest people were concerned that if you didn't have a reversionary pension, you'd miss out on the exemption, but that doesn't apply either.
Yeah, now, Gemma, I'm going to go a little bit left field now, not off piste, but left
Oh,
field.
left
So this
field.
this is a
Okay.
this is a
Into the
different
slush.
this is a different dynamic for us. We don't usually go left field, but I think whenever these discussions arise, and I know again, I've seen your presentations potentially in front of live audiences where people stick their hands up and they raise concerns about, oh, but hang on, Gemma, that sounds really, really good and really powerful and would get to a great outcome. But does it transgress the Part 4A rules?
Yes. Good old Part 4A.
Because you are trying to gain a tax benefit. Would that be considered a scheme of sorts to potentially avoid tax or avoid a tax liability? So it's a little bit left field. It always gets raised when we talk about tax positions within super. So where does that sit?
Yeah, so particularly with the withdrawal and recontribution strategy, because mostly why are you doing it? You, okay, you might be looking to equalize between spouses, that's okay. But really, you're doing it to save tax for the kiddos in the future. So the tax office has looked at that. I feel like it sort of pops up every 5 or so years that they ask the question. There was some NTLG, so National Tax Liaison Group, super subcommittee meetings back in the late noughties, I think 2009. Is it Part 4A? They've been asked a number of times. So really, the outcome of that is no, it's not. And one of the basis for that is that you're not getting a tax benefit now. You're potentially getting a tax benefit in the future at some unknown point. So when you don't know that if Homer's done all this planning now, he might rip it all out of super before he dies. It might go to Marge, so it's not really impacting him. So that because the future is so unknown, the rules might change by then, type thing. So you can't sort of say, well, you're doing this now, and that's Part 4A for an unknown tax outcome in the future. So that's really sort of, again, high level where they've landed is that it's not Part 4A. But that could, turn on a dime potentially, and change in the future. But it makes sense from that perspective.
Yeah, well, I'm glad there's a common sense approach to it, obviously. And I think the ATO, correct me if I'm wrong, Gemma, the ATO has stipulated on many different occasions with many different scenarios as well. It is about that immediate gain, and it
Mm.
is about the immediate gain for the actual member themselves.
For the
Um,
taxpayer, yep.
yeah, exactly. So numerous times you've mentioned, well, right at the start of this podcast, actually, you mentioned basically when people look at this sort of stuff and look at withdrawal and recontribution strategies and look at changing that mix of taxable and tax-free component, it is looking at, you know, uh, Bart and Lisa and
And Maggie,
Maggie
yeah,
a little
100%,
bit
yeah.
down the track, as opposed to Homer's just doing it for his own benefit. So maybe he can, I don't know, he can get more bacon
Yeah, more donuts, more
or more
donuts.
donuts or more
Yeah,
pork chops
yeah,
out of his superannuation benefits. So it can't really be argued, if they're consistent with that approach, that it is actually an immediate benefit for the actual pension recipient super fund member themselves.
yeah, that's right. And it was and you don't know who's going to benefit in the future. So is it, again, it's not going to be Homer himself because it's, on death. So is it Bart, Lisa, and Maggie? Is it not them? It could be complete other, randoms or other dependents, or he, if Marge dies and he marries Mrs. Krafoffel, I've pronounced that incorrectly. Edna, he marries Edna, and then Edna's got some other, from that perspective as well.
Yeah.
We should have used Han Solo and Princess Leia and
Well,
Kylo Ren as our references.
well, I was going to say that you're not saying that Anakin is mucking around with his super to leave some benefits to Luke and Leia,
No,
which he could
no,
do, but
could do.
I
Yeah,
suppose he wouldn't know about that, would he? Because uh, that whole family situation was a little bit clouded
yeah,
in
very clouded.
episode 4 already. So we
Very
wouldn't it
much
wouldn't be a
so.
logical step to say
No.
that Darth Vader is going to be looking after his children when he hadn't even revealed that he was their father in the first place.
Oh, hilarious. And there,
But
now we're off piste. Now
we
we're off
are
piste.
totally off piece, but we still achieve the aim. We've
Yeah,
got
we
The
do.
Simpsons and Star Wars
Yeah.
in, and of course you're right about, how do you know upon death what your circumstances will be as far as who benefits? Because, of course, and I know you've spoken about this a lot, Gemma, more and more we're seeing blended families.
Mm,
So
that's
even
right.
right now, it's completely unpredictable in the event of divorce or whatever might come of it, that you've got a blended family, and then there's no way you could predict right now how that's going to play out.
Yeah, 100%. And even I've got a matter at the moment, and there's 4 pensions in the fund, and two of them are reversionary and 2 of them aren't. So a fresh contribution has gone in, and we're looking at a new pension. And so the consideration is, I'm like, oh, I don't really like reversionary pensions. Let's make it non-reversionary. But then, so, we've been talking about super components. Now we're flowing through, well, this again, Homer dies. He's got 5 pensions. 3 of them are non-reversionary and 2 are reversionary. What a disaster. Like, that's again the faffing around from that, because there'll be reporting required pretty quickly for the 2 reversionary ones, but not for the 3 other ones. How does that all get managed? Poor Marge is having to deal with it. Then if it's not Marge, but it's Edna, does Homer really want them to revert to her? Like, all of that, sort of how it all flows out. And so sometimes consolidating them might be the way to go, and just saying, right, if we consolidate these all together, you're only taking the minimum out, and in fact you're not spending it. So do we just consider it from that perspective, aggregate it all together, and look at how those tax components flow out? Again, that's a big consideration to understand what the flow on effect is. Are the right beneficiaries nominated in these? And I think that's the issue. A lot of people are managing tax and don't realize, well, that's going to Edna. And let's say Homer and Marge have divorced, rather than Marge has died, well, Homer might want that money to go to his kids. But if it's reversionary to Edna, then that's not getting the outcome that we want either. That is not the droid we would be looking for.
No, no, but I know that in these circumstances, we can't apply Jedi mind tricks to try and get our way around that. Wouldn't it be good if we could?
I know it would be good. It'd be really good. Yeah.
No, this is not a taxable component ATO.
Yeah.
Move
Move
along.
on. Move on.
How good would that be?
That'd be really good. Very funny. Such
Yeah.
dad jokes. We're getting all the dad jokes in, aren't we?
Yeah, I know. It's a bit of a shame. Again, a shout out to Peter Burgess if he is watching. I'm sorry, we're encroaching on your
Oh yeah,
area
he's
because he is the self-confessed king of dad
dad
jokes.
jokes. Yeah.
So
Oh goodness.
apologize, but look, I confessed that I do love a good dad joke. Who doesn't? And
Yeah.
when we're talking about Homer and Marge, well, come on.
Yeah. So I think the I guess the lesson from this, well, what we're talking about today is it's awareness, and also, so most of the super funds in the country use the modern software. So you're talking, your classes, your BGLs, your supermates, all of those sorts of ones. But there are still a lot of accountants that use I'll call it standard practice software to do their super funds, which is perfectly fine. And actually sometimes can be more efficient because you're just taking up a line item rather than every transaction. Anyway, we digress. But the new systems, they have those quite comprehensive member statements that go through what the tax components are and things like
Mhm.
that. What we do encounter is where the other systems are used, if the accountant isn't keeping sort of a spreadsheet showing what the taxable components are, the history of that gets lost. And so we are actually, and MYOB, you're just keeping it as a balance sheet and P&L, and making sure you've got a market to market and everything. But there's no like really strict requirements on the financial statements having to go through one of these modern softwares. You can use any accounting software that you want, but it's
Yeah.
important that this other stuff is kept in the background. And so obviously with the modern softwares, it shows those components, but I do encounter ones where the accountant isn't keeping comprehensive Excel spreadsheets, and those crystallization calcs weren't done back in 2007. So trying to figure out what Homer's tax components are now of his accounts when those calculations weren't done back then, that is a real challenge. So just watch out, I guess, from that perspective. Yeah, it's one of those. I don't encounter it very often, but I just know in more recent times, I think in the last year, we've probably encountered about half a dozen funds where the tax component history is a bit skeptical because they had, they're in their late 80s. They definitely had some pre-July 1983 service, but that's not reflective in the taxation components, those sorts of things. So it's just again trying to get that information. And 2007, we were electronic. No, that sounds like a silly thing to say. Back when I started, we were using DOS programs. So all these youngins will be like, "Oh, what's DOS?" DOS was great.
Yeah.
Loved DOS. So yeah, these the way that things have evolved with from that software perspective, it's just making sure that those sorts of things are captured. And it's a bit like reviewing the reversionary status and getting the original pension documents for all your clients' pensions when you pick up a new client or you're doing a review, just to make sure, because the software might say, oh yep, it's reversionary from Homer to Marge, but you can't find the original pension documents that actually say that. So it's an assumption. And then now we know that if it's reversionary or not, that in itself is a whole raft of different implications for transfer balance cap. Also, well, if it's reversionary, does it actually continue on? What does the deed say about a binding death benefit nomination taking precedence against a reversionary? If it's not reversionary, it goes back into the fold. Is it trustee discretion? Da, 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 da. So it is really important. And I know, again, I've digressed into talking about estate planning things, but the super interests sort of they're managed a lot for that purpose. So it makes sense to be aware of that overall position.
I think you were very generous there, Gemma. You called the situation at hand that you'd seen in maybe 12 instances a challenge. I would call it an absolute nightmare. Personally, to have to go back and in any sort of accounting field, suppose you could say not just superannuation. If you have to go back and reconstruct stuff that hasn't been done properly in the first place, good luck with that. That is
Mm,
going to take a long time. And again, I suppose one of the messages that we're putting out there, again, off-piste, not really related, but everything's related, is how important it is to have a full history of what has happened to the fund. I know it's not easy, but a full documentation history, a full audit trail of exactly what decisions have been made, you know, how all these components have fit together over the past X number of years. And of course, legislation change makes that
yep.
so difficult, as you raised.
So,
Oh,
the Simpler Super was 2007.
yeah,
So that was, however, 17 years. Oh, that's showing my age. And so yeah, trying to and they a lot of those pensions may well have just continued on and been in place well before that. So trying to get that information is a real challenge. I have been sort of encouraging practitioners when they pick up a new client to, as part of their onboarding, to do that exact what you just mentioned, like that whole a bit like stock take. Do you have all the documents? Have all the deeds been signed? Are they all witnessed if they need to be appropriately and dated? Do you have that whole suite of reversionary pensions, death benefit nominations, all of that in place? Because then you don't want it to happen that Homer dies, and then you look through it all and you're like, oh, that binding death benefit nomination was not signed in
yeah.
accordance with the correct deed and actually is invalid, eek, type thing. So it's really important, I think, to go through that. Now, the challenge with that as a practitioner is you pick up a new client, or even your existing clients, just going through that process is its time, and obviously time is money, and how do you make sure you can get compensated for that, especially if you come through and go, right, did my job, it's all good. Well, well, why would I pay you for everything being fine? That sort of thing. But anyway, invariably and I'm sure most people, when they pick up a new client and they look through everything, they're like, oh, that deed wasn't dated, or oh, that death benefit nomination wasn't witnessed. Those sorts of things. So something does pop up, and the comfort that clients have hopefully trumps the cost.
I think the official term is
Mm.
your onboarding checklist, isn't it,
Yeah,
Gemma? That
yeah.
makes part of your See, I do listen to your presentations.
Oh, aren't you good?
Always. So yeah, really important stuff. And boy, haven't you been a bit bloody harsh on Homer today?
Yeah, poor Homer. Killed him
Homer
off.
seems to be carking it in just about every scenario that you've presented.
Well, one of my favorite scenarios is where Homer, so Maud, those who watch The Simpsons, poor Maud dies in a t-shirt gun accident. She gets like, those t-shirt guns that they
Oh
shoot at
yeah,
sporting
yeah,
events. And so she gets
yeah,
clocked in the
yeah,
chest and
yeah,
falls off the back of the bleachers.
yeah.
So she dies. And then Homer dies from too many donuts, basically. But then Marge and Ned get together. So that's my blended family scenario.
Gosh.
So, which is, you've got to make it interesting when you're dealing with some of these dry topics. So yeah, that's how
Gosh,
I make it interesting.
that's a bit of a twisted scenario.
Yeah.
Marge and Ned Flanders. I suppose they are neighbours, though, aren't they?
That's right, 100%.
We've seen stranger things happen.
Oakley dokley.
Well, Gemma, on that note, guess what? We've run out
We're
of
at time.
time
Yep.
because we've had so much fun as we usually do presenting these podcasts.
Yeah, as per normal, lots of fun.
So, look, we hope that everybody's got something out of the podcast today, and we hope you enjoy listening and watching it as much as we enjoyed bringing it to you. Thanks again, Gemma, for joining me all the way over in Perth.
Thanks, Darin.
And also thank you to my team as well, because they're the ones that have to sit through these things, record them, and put them together. So a big thanks to them. most importantly, thank you to you for joining us. Again, we hope you got something out of it, and we hope you enjoyed listening to this content and watching this content as much as we enjoy bringing it to you. And don't forget, if you are enjoying our content on YouTube, please smash that like button and subscribe to the channel. Other than that, I bid you farewell. Enjoy the rest of your day, and we look forward to having you with us for the next episode of the Cross Country Super Podcast. Bye for now.